In second grade, I got into trading baseball cards, well, all kinds of sports cards. It has a lot of parallels to trading stocks, right?
When you got to Duke, did you know that you wanted to work in finance?
Well, I knew I wanted to do something like business/finance. One visit to the trading floor and I was sold.
My initial job was at Goldman Sachs, and I'll never forget, my dad actually told me when I got that job, he said, "I'm really proud of you. I hear that's a really great company to work for, but always remember to try to carve out your own thing down the line."
Oh, not what a lot of parents say when you come home and say, "I got a job at Goldman Sachs," right? Exactly.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions.
Welcome to the first episode of On Point, a podcast from Element Pointe Family Office. I am David Savir, CEO and co-founder of Element Pointe. I am joined today by my co-founder and our firm's chief investment officer, Carlos Dominguez. Hello, Carlos.
Hi, everybody.
Carlos, your background is so interesting for someone in the wealth management space. You've been a portfolio manager or trader for the better part of the last 30 years. But unlike a lot of individuals in wealth management who spent their careers in wealth management, you really started as a market maker and trader, and then as a portfolio manager at a hedge fund before ultimately finding your way to wealth management. So would love to hear a little bit more about that and how you got started in this industry.
Sure. So let's go back to childhood. You would think that.
You were trading stocks as a child?
No. But there was a nice parallel because in second grade, I got into trading baseball cards, well, all kinds of sports cards. But at that time, baseball cards were really the most valuable of the sports. And you really it has a lot of parallels to trading stocks, right? Because you're trying to determine which players are going to do well in the future. And obviously that would drive the value of the cards. That was like a passion of mine for the first, I'd say from second grade to middle school. I also got into my dad and, our family and our friends, we'd host poker games at the house. So I got really into games of chance, decision making with imperfect information, learning about risk reward. I played a lot of backgammon as well. So I think all these things prepared me for when I got to college. And I should say that, my dad's a doctor, my mom's a microbiologist, and they invested all their excess savings in for rent real estate. So the market was not something we talked about at home at all. But when I got to Duke, met a lot of friends from the tri-state area. Many of them came from families that worked on Wall Street, or many of them just had Wall Street ambitions. And that sort of was what lit the fire and the light bulb of equity, capital markets, investing, et cetera. So that was really my introduction.
So I'm curious, because we've known each other for 13 years, and I actually don't know this about you. When you got to Duke, did you know that you wanted to work in finance, or did you get there with an undeclared major and then figure out what you wanted to do when you got there?
Yeah, I knew I wanted to do something like business/finance, but Duke is a liberal arts school, so there was no quote unquote finance major or business major. The closest thing was an economics major. I knew I was going to major in economics, but once I joined a fraternity and got close with a lot of my fraternity brothers. As I mentioned, many of them came from the tri-state area. That's when the interest in markets really started to develop. And actually, my first job kind of came directly from a fraternity brother who was 2 years older than me. He had gone onto Wall Street and became an equity options market maker. Most of my friends went into the investment banking program, and that's what I thought I was going to do. But he introduced me to his boss, who was another young gentleman who had started a trading firm, because he saw a lot of parallels in me that he himself had and had a lot of success doing that. He thought I had a great temperament and really understanding of risk and reward. And so he recruited me to come trade for them. And I I found it fascinating. One visit to the trading floor and I was sold. So I did that. I was an equity options market maker, probably at the time the youngest person to be licensed, because I'll never forget, I started trading, taking risk the day after Thanksgiving, right after graduation. So I was probably 22 years old.
Wow. And so the cool thing I think about that is what you actually started doing is a job that doesn't really exist anymore in the same way that it did back then. Because that was 94.
That was 94.
Floor of the exchange. On
the floor. And this was the Amex options exchange. Well, the Amex exchange, which primarily the biggest business, there were some stocks that traded, but equity options and index options were by far the biggest business. And you're absolutely right. At that time, floor trading was huge. All the equity options trades actually happened on the floor of an exchange. So the CBOE was the biggest. The Amex was the second biggest. And then there was a floor in Philadelphia and one in San Francisco. Today, all of that business is basically done electronically. There is no real floor presence, much like the new NYSE for stocks as well. Where most of all the stock used to trade on the NYSE, if it was NYSE listed. Now, most of the trades are happening in dark pools or just off exchange. So it's pretty fascinating.
Yeah, and we'll
disrupted that business.
And on a later episode, we may unpack the whole idea of dark pools and off exchange trades and things like that, because that's, I think, a topic people are interested in learning about and don't necessarily haven't heard that much about. And then you eventually moved to San Francisco because they started a new exchange.
It wasn't a new exchange, but I'll take a step back. So I loved trading options, but the system on the Amex was, it's called a lead market maker system. And so certain firms are designated the lead market maker in a trading pit, and you had to have a lot of capital and be a big firm. My firm was not a lead market maker. We didn't have enough. We weren't well capitalized enough to do that. And so the system is, by being the lead market maker, they were guaranteed a certain amount of the volume, and they sort of like dictated what happened in the pit. And so it was hard to distinguish yourself too much as a trader. And I was frustrated about with that system after a while. So I thought I was going back to business school. I took my GMAT. I was ready to go. And that's when my boss, they came to me and they said, listen, would you consider moving to San Francisco? There's an options exchange out there. It was very levered to all the tech companies that were being listed at the time. It is a complete open outcry system. So there is no lead market maker on that trading floor. Basically, all the traders in the pit fight for all the order flow. And if you're good, you get as much as you can handle. And it's in San Francisco, and we want you to build and manage a team out there. And so, I mean, it was music to my ears, right? I was like coming from Florida back then, like everybody wanted to move west to California. So I was like, I'd love to live in California. I'd love to keep trading, but in a system that I thought fit me better and was much more attractive. And so I took him up on that opportunity, and I had gotten a great GMAT score, but I recognized that it was, I think, good for 5 years or something. So, I could always put those plans on hold.
All right. So now we're in San Francisco, trading on the exchange there.
Yep.
And then at some point you decided, okay, I'm going to go and, do my MBA. You went to Stanford and did your MBA there. What was the catalyst for that, transition?
So it pivots back to something you said earlier, which is like these floor trading doesn't really exist. So in the late 90s, the ISE, the International Stock, I think it's International Stock Exchange, but it was an all electronic exchange launched. And I saw like that was sort of where the business was going to eventually go. So I I knew that if I stayed on the floor forever, it was sort of a dying business. My GMAT, as I mentioned, my GMAT score was going to expire the following year. So I thought it was a good time to sort of take a break and go back to school and reassess, and whether that meant staying in California and staying in trading industry or doing something completely different. So I went to Stanford in 2000, got out of there in 2002. This was also, if you can imagine, late 90s, San Francisco and the Bay Area was booming. Then we had the dot-com crash. So in 2002, when I got out of school, it was still a pretty depressing time in the Bay Area. So I, focused on moving back to the East Coast, especially New York. And that's when I decided, working at a hedge fund that a friend of mine from Duke had recently launched. And I started as an analyst, but like coming up with all kinds of like derivative trading strategies, but quickly learned that to do like these derivative strategies, you definitely need a little bit more of like a longer term view, at least the ones that I was coming up with. And the fund was very trading oriented. Like we sort of moved in and out of positions very quickly. And so sort of talked to the founder of the fund and you know, he said, well, why don't you just, I'll separate assets and you just start managing a book. And if you want to do derivative strategy, you can do that, or you can do long short, or you can combine the two. So he gave me a pool of assets, and over time, you know, I managed more and more assets. And so I was a PM almost my entire time there, which I spent almost 10 years there.
Nice. Nice. And then the next step is actually where you and I started working together, which was a big pivot. So for listeners' benefit, we started working together at JP Morgan, back in 2012, which for me was a continuation of a career spent in wealth management. I had started at Goldman Sachs in wealth management out of law school and business school, and then got to JP Morgan in 2012 to help grow that business in Florida. You got there as well, and that's how we started working together. But for you, that was a huge pivot from the institutional asset management world and the hedge fund world to wealth management. And what were the biggest surprises or learnings in that transition?
Yeah, so I mean, just to give you context, I'm originally from Miami, and so our hedge fund was growing nicely and then the great financial crisis happened, and we never gated investors, and it was a time when a lot of funds were gating investors, meaning investors couldn't get their money out of a lot of different hedge funds, but we never did that, and so we kind of went in reverse. And so after, you know, a year or two after that, I knew that, like, number one, I had gotten married. I had my first child in New York. We found out we were pregnant with our second child, and the hedge fund, we had sort of stalled out on the hedge fund growth side. So I knew it was time for a change, and I wanted to raise my family in Miami. I had such a good positive experience raising with my childhood in Miami. So I was hoping I could find hedge fund opportunities in Miami, and, you know, made a lot of calls to people, and there really wasn't much of a hedge fund community here at the time. That's changed since.
It's funny to say that now.
Yeah,
because
it's funny to say that
fast
now.
forward 13 years and, you know, half of New York City's moved down to Miami, and the hedge
That's
fund
right.
community's
It's a very different environment today. Yeah. But, you know, I reached out to a lot of people who I knew and that I thought highly of, and they connected me with a lot of like talented folks in the wealth management industry and at different firms, but not at JP Morgan, actually. The JP Morgan connection, I had looked on the Stanford alumni directory of who was in Miami, and one of my classmates was on there as having recently moved to Miami for JP Morgan. And he was running the investment for all of Southeast United States for JP Morgan's private bank. So I reached out to him, and he encouraged me to come in and talk to the team. He said they were hiring, they're aggressively hiring because they were building out a team after all the acquisitions they made post the GFC. So that's sort of, you know, I came into that hiring wave, and so did you, actually.
Yep.
But it was definitely, it was a career change for me. And originally, you would think I would go into the investment specialist role, which is one of the roles at the private bank. But, you know, after speaking with him and some other folks, they encouraged me to go be a banker there, which is sort of the lead, the quarterback of the relationship, the business development person, the lead advisor. And so I thought, well, why not try something a little different? And, you know, it was tough to make a slight career change at my age, but you know, I had fun and I took the challenge.
Yeah, and for those that are listening and not watching, he said at his age, he's not 100 years old or anything. Yeah, you're what? You 52 now?
I turned 52 last year, so I'll be 50. I'll turn 53 this year.
Okay,
Yeah.
Okay. And I'm actually 10 years younger than that, but you look younger than me, so it's a disappointment every day when I.
Well, I think it's the hair, right? Yeah. I've managed to keep my hair.
So 2012, you know, we started working together. I think by the way, that was for me. That was sort of the start, I think, of a process toward figuring out other business models in the wealth management space that ultimately led to the founding of Element Pointe and the way that we manage money and work with investors today. I mean, my education in that probably began a little bit earlier because I've always wanted to do something more entrepreneurial and kind of carve out, my own path or the path that I thought would be best for serving clients in this business. But I think when you and I started working together, we started kind of developing, the thought process that ultimately led to where we're at. So
but before we talk about JP Morgan, I mean, why don't you tell us a little bit about your background? And I can tell you from the moment I met you at JP Morgan, you were a student of this industry. You knew.
Yeah. So I mean, I've always worked in finance and wealth management, but I always thought of it as like a business operator first and the industry or business second, right? Like the most important thing to me. So I grew up around a lot of entrepreneurial people. So you mentioned, your parents as a doctor and microbiologist. And so for me, I grew up around people who generally started and owned businesses. I wasn't really surrounded by doctors, lawyers, accountants, and people in those professions. I was surrounded by a lot of people who started mainly small businesses, but people who started a variety of different types of small businesses. My parents were among those people. They had a small business that sold picture frames. And so I grew up around a lot of self-employed individuals, and I was the first one that kind of had the opportunity to go to law school, to graduate school. And, I came out and my initial job was at Goldman Sachs, big bank in New York City. And I'll never forget my dad actually told me when I got that job, he said, I'm really proud of you. I hear that's a really great company to work for, but always remember to try to carve out your own thing down the line. And
not what a lot of parents say when you come home and say, I got a job at Goldman Sachs.
Yeah,
right?
exactly. So I guess my thought process always worked that way, but I was also really driven by trying to find a better way to do what I was doing. And so in this case, like in the wealth management space, I came into the business, started learning about, the banking and brokerage model. And that was at the time like the dominant, sort of prevailing model where people went for wealth management, because you had, back in the day before the internet, you had this massive information asymmetry, right? Like people couldn't just get information at will about any stock or investment that they wanted. They had to rely on a broker to provide them that information, and then they could make decisions based on the information provided to them by that broker. Well, the internet changed the entire world in that way. And so at the time, and this predates my career. I mean, I started summer 2008, just before the financial crisis, as a summer associate, and then graduated from my grad programs in 2009 and started working full time then. But as you mentioned, I'm kind of a student of the industry. So when we think back to when the internet revolution happened, it changed the brokerage industry. And so a lot of these brokerage firms and banks, they said, okay, there's not much value in us providing information for the purpose of telling people how to transact and earning commissions on those transactions. Let's pivot our business model to managing money and charging a fee for managing that money. But they never dropped that other side of the business, the getting paid for transactions and commissions for, recommending funds and different things. And so they ended up in what we now call a hybrid model, where they have these investment advisory businesses, but they operate them in conjunction with these brokerage businesses. And then that created, in my view, this even more conflicted way of delivering wealth management services to investors, because now the investor has to try to figure out, when is this person acting as my advisor, or when are they just selling me a security? And that is a product of this evolution of the business from what used to be a purely transactional business to what became an advice business. But I started looking around and going, well, why isn't there just an advice business?
Right.
And so that was how I started to learn about this whole concept of being what's called a registered investment advisor, and being more importantly, being a fee-only advisor, which basically means that you get paid one way, and that's for providing advice and portfolio management to clients. You're not getting paid by third parties like fund managers or brokerage firms. And that really changed my whole thinking on this business, when I realized that I could do this and just truly be an advisor to people and not have all of these competing and conflicting incentives. And so that just met and aligned with my desire to be a business owner, entrepreneur, right? Because here was this thing that not many people were doing in a way that not many people were doing it, and also could provide the opportunity to build a firm and a business. And so I think, I was probably in your ear from like 2013, 2014, telling you we should do this.
Early on. But, I always found fascinating because, well, first of all, you have a JD MBA, right? So any thought of ever like going into the practicing law, or that was just
It's a good question. No. And the reason why not is actually more to do with that entrepreneurial side of things. So law to me, and certainly no disrespect to any lawyers, it's a very rewarding career, and a lot of my friends practice law and are happy doing it and have had incredible careers. For me, the business model of law from a business perspective seemed really inefficient. Right? Because you're on a billable hour for the most part. There are lawyers that are not billable hour, like contingency fee and some that get compensated by deal and so on. But for the most part, you're on a billable hour. And to me, maybe I didn't think about it perfectly at that time, but to me, it seemed like very limiting in that way, right? If you're limited by the number of hours in your day, at least certainly in the earlier years of your career, you're very limited by the number of hours in your day. Later on in your career, as people build law firms, they've got lots of lawyers underneath them.
You got people working for it.
Correct. And you get that scale. But otherwise, in the early days, you're very much limited, by this billable hour structure. And I never really thought that was a great business that I wanted to be in. I like the intellectual exercise of studying law, and it helps without doubt helps every day in this business, whether it's estate planning, tax planning for clients, reviewing a deal or transaction. I mean, we recently helped a client, evaluate, some general partner economics that they might be receiving from a private equity firm that they'll be an advisor to. Doing all of those things, certainly having that law background has helped me, but I never really considered actually practicing.
So you went to work for Goldman Sachs, and this was in 2008, right? Right in the middle of the financial crisis.
Yeah, it was the worst.
I was a summer associate at Goldman in 2001, so that was during the .com bust. And I remember they were cutting recruiting in half and all that. So I can't imagine stepping into one of these big banks during that time. You had to wonder, am I going to have a job in 3 months?
It was definitely an interesting time. So summer of 2008, I was what they call a summer associate. So I was in between my third and fourth year of graduate school, and I worked for Goldman. And you could already feel, you could certainly feel at that time things were changing in the economy, but this was before Lehman Brothers went bankrupt, and the government had to step in and basically rescue the banks. But you could feel that things were changing. And I remember at the end of that summer, they told all of us, there were about 33 of us in the group, and they told all of us at the end of that summer, normally we would make full-time offers right about now, but we're going to wait a little bit and see what happens. So, wait to hear from us. And then a couple months goes by, and Lehman Brothers files for bankruptcy. AIG needed to be rescued. And I'm sitting there, thinking to myself, there's no way I'm going to get a full-time job offer. How could this be? There were rumors about, at the time about who's going to be next, right? Yeah. Was Goldman going to be next? But sure enough, I ended up getting, I was very lucky. I was one of, I think, around maybe 25 people or so that they brought in on the investment management side, that year on the wealth management side. Normally, I think the class would have been 5 times that size or more, but it worked out. But that was a great training ground, right? Because I came in basically in the middle of 2009. So the worst had happened already. The S&P 500 bottomed in March, but still the markets were extremely volatile. And when I landed, what I found was a lot of extremely shell-shocked investors who had just gone through this incredibly traumatic experience of seeing their portfolio values. And this isn't just at Goldman, this is across the board, sure, right? Sure. All over the world. They had seen their portfolio values just decline very quickly and in a fierce order of magnitude. And so right from day one, I had to really learn how to deal with the psychology of investors, particularly individual investors, because, here was this group of people who had just gone through kind of this traumatic experience from a financial perspective, and you're trying to encourage them to take a long-term view and do all the things that we know historically have worked out well. And by the way, since then have worked out extremely well for investors, which is to remain invested and, have faith in the endurance of financial markets, particularly in developed markets like the US, but very difficult to do that when investors just seen their portfolio value decline by, 30, 35, 40%, or more. I mean, the market was down 65%.
The S&P at one point was down about 65%.
Right.
So.
But a lot of portfolios that didn't have fully, equity exposure, they were still down, 30, 35, 40, 45. If you were really aggressive and were all equity, you were down like 60. It was an interesting time. People were mad at the banks at the time. That was actually, I think, probably the most difficult part of all, is like shortly thereafter you had the Occupy Wall Street movement, and you had this just hatred of the banking sector. And I remember being on the phone with clients, and, at the time, Lloyd Blankfein, the CEO of Goldman, was testifying before the Senate Banking Committee and just getting absolutely grilled by Carl Levin.
Didn't the Post call him like the purple squid or the
Yeah. They referred to Goldman at the time as the giant vampire squid shoving its money funnel into anything that looked like money or something like that. I'm misquoting that slightly, but here I am in this environment where I've come in, and I'm probably a little bit idealistic at this stage. I'm like, this is great. I'm going to come in and help people, and you do. But the narrative at the time, I think in the U.S., was this just like very vitriolic negative view of banking. So it was a really interesting dynamic at that time. But
what a crazy time to start a career, and especially in this industry, working for one of the big guys.
Yes.
Under, a lot of scrutiny and pressure, for sure.
Yeah. But you learn a lot, right? Like there's this, I don't know, there's this proverb that I could not tell you who to attribute it to, but it basically is, smooth seas don't make skilled sailors. And I think that's so true, because it accelerates the learning curve. So I feel like I learned in those 2 or 3 years so much more than I would have in a calm market environment in those 2 or 3 years.
And you had to too, because I think, isn't Goldman's model that you have to become like self-sufficient in 2 to 3 years? They don't give you much time.
Yeah, you have a fairly short period of time. And so when I came in, and this is, I'm not sure what their sort of minimums are today, but when I came in, the minimum relationship size there was $10 million liquid. Today our minimums here at Element Pointe are higher than that, but back then I didn't know anybody with $10 million liquid. So it was a really interesting process of developing that network.
A phone book?
Exactly.
Phone book and a phone and
getting exposure. And I'm 26 years old at the time. I'm 42 now, but 26 years old at the time. And so it was a really challenging few years, but learned a lot. So learned a lot about the business, learned a lot about the economy. There were programs going on then, like the Troubled Asset Relief Program and, the rescue package that Congress passed. I mean, those things were unprecedented for the most part. And I'm a history nerd, right? So you can go back to, things like the Panic of '07, and then basically, the banking industry effectively stepping in to kind of backstop, a massive market sell-off. And then, but, largely like the Fed or Treasury stepping in at that scale had really never happened before.
Yeah, we even invented quantitative easing.
Correct. So it was
a lot of meme videos online about trying to explain, the Bernanke.
The Ben Bernanke.
The Ben Bernanke.
Everyone remembers those. It was a series of YouTube clips that was popular at the time.
So funny.
But it was a crazy time, and you learn a tremendous amount during periods like that. So I was very fortunate. I got to step in and learn a lot in a fairly short period of time. But it also taught me to be intellectually curious and study kind of independently of the information that was being disseminated to me. And that kind of started the process of thinking about like, hey, what's in my view, the best way to do this business, which ultimately kind of took us to where we are today. So that's my story.
Yeah, no. And so you were recruited as, we sort of got on this tangent, but like you were recruited in 2012 to come work at JP Morgan. It was the same time frame that I joined, and we had tons of people joining. I mean, I remember at every Monday morning meeting, it was almost like we introduced a new employee every week.
Big growth period for sure back then.
Big growth period. we ended up for a brief period of time on the same team, doing the same job because you were a banker there as well. And then eventually you moved to the ultra high net worth team. But they made the mistake of sitting us next to each other at some point. And those conversations that you referenced became more and more intense over time. And sort of the early days of Element Pointe were sort of seated there.
Yeah. And I think it's important to just like take a moment also to elaborate on, what exactly, our business model is and why it was certainly more novel at the time than it is now. But, cause there've been a lot of, every year there's firms that pop up with, some variation on the theme. But, as we were talking about earlier, increasingly high net worth, ultra high net worth families, they were looking for advice that could really cover a lot of areas. And so what I mean by that is, managing money for a family or advising a family, it's so much more, as you know, than just like managing an account or a single portfolio. Often there's these big complex structures. They may have had, various trusts or family limited partnerships or LLCs or all these other entities created, and there's an interplay between all of them, right? They all kind of make up the pieces of this bigger puzzle. And families were looking for somebody who could really advise them across that entire puzzle. And that puzzle doesn't just include, stocks and bonds. Obviously it includes private equity and private real estate investments and things like that. But there's, investments that are brought to them by, that's the first thing you learn, I guess, when you make a lot of money, either selling a business and it's like being an NBA draft pick, right? Everybody starts calling you and has a great investment idea. And then everybody, in your family, everyone in your distant family also has a great business idea and wants some money. They're constantly bombarded with all of this information and all of these different opportunities. And there are very real limitations, to the kind of advice they can get in the banking and brokerage world. Like, for example, if you're at a brokerage firm and you're an advisor there, you are subject to FINRA's rules. One of FINRA's rules is that you cannot advise, you cannot sell away, which basically means that anything that your firm is not selling, because you're at the end of the day, there's a commission component. Anything that your firm is not selling, you can't give advice on. So a client comes in and says, my brother-in-law is a real estate developer and, here's the deck on a deal that they're doing and, would love to know what you think. When you're sitting in that seat at a brokerage firm, you actually have to say, like, I can't really opine on that. I mean, a lot of people will bend the rules and they might have like a, 15-minute phone conversation and, talk about it on a high level, even though the compliance department at those firms probably would not like that they do that, but technically you can't opine on it. So you can see why that's an issue if you're a wealthy family, right? Because here you are looking for somebody who can advise you on everything that you own. And then here's this party on the other side of the table that's limited in their ability to advise you on everything that you own. So, we wanted to solve for that problem. We wanted to solve for the problem of, consolidated reporting, being able to see everything you own in one place in a consolidated manner. And then, of course, like the overarching issue that families were facing, which is, how do I know that I'm getting objective advice here that's not being driven by a commission incentive for the sale of a particular product? And so, we started, you and I, doing a ton of research on the way to do that. And that started with, finding what are called qualified custodians first, like institutions that could hold the assets of clients, because you never want to be holding, client money. There should be a separation there between who holds the money and who manages the money. So in our case, we worked with Fidelity Investments since day one. And then at some point down the road, we added Schwab as a custodian as well. But we really, started putting the pieces together, technology and all of that, which ultimately led to, launching the firm in early 2016. And it's worth noting that when we did start the firm back in 2016, I think our entire office was basically this, like one table, you and me, and a couple laptops.
Come a long way, David.
So yeah, it's been,
one of the big surprises, because you mentioned technology. I remember, I was, a lot of times clients, would ask me, okay, I'd love to kind of have a portfolio review with you. How am I doing? And I remember, it used to take like 3 weeks to a month to put together a report, after the quarter end. And then it was like 100 pages and it was hard to decipher how they actually were doing. They just wanted like simple questions answered. And oftentimes it wasn't easy because, you mentioned sort of the sale of financial products. A lot of times it wasn't just one simple managed portfolio. It was a collection of strategies that had been sold to the client over time. It was remarkable to me that inside of this large organization, we weren't able to provide just such basic information in a timely fashion. And when we started doing diligence on technology providers and, that work with RIAs in the independent space, like our eyes were like, we were blown away. Our eyes were wide open. And, at that time we had an analyst with us who came over from JP Morgan as well. And he was just like, wow, this would save me like a week of work using this technology platform, which it ended up, we went with Adipar. And
so I think just for those that are listening, like that story is actually a great one, because so we use and have used for years. There's a number of different softwares that we use in our business, but one of them, which we use for portfolio reporting and analytics, is a software vendor called Adipar, which we've worked with for really the last 9.5 years since we started the firm. And they were still are a very innovative company, but a company that really innovated in the way portfolio reporting is done for very wealthy families across numerous portfolios, and they enabled investors but also advisors to see portfolio data in a way that had been really difficult to achieve prior. And I think we were like customer number 225 or 220.
They call us OGs over there.
Yeah, they call us the OGs there. But when we went there the first time, it's funny. I don't know what their office looks like today. I know they have one in New York too, but when we went there the first time, it was like a converted warehouse with a bunch of software developers in like shorts and t-shirts with their like pets running around. And it eating Taco Bell and like developing software. And we were like, these are the guys that are like,
it's a fascinating cultural difference, we had come from Fidelity, if you remember, we
from their office.
Trip, we first went to Fidelity to visit with our, Fidelity became our primary custodian, and a long historied firm. And, we saw Ned Johnson's office and his chart room and everything. And then we go out to San Francisco.
Yeah. The bathroom was a locker room.
The bathroom was the locker room. People were showering. There was pets running around everywhere.
By the way, in case anyone from Adipar is tuning in, it was awesome.
Yeah. And, amazing. We came home, it was like, we're using Adipar.
Yeah. But, we sat in this room and they showed us this demo, and the analyst, our former analyst who had joined us, and shout out to Tarek, who probably will listen to this. When we first started the firm, one of our former analysts was actually launching a tech startup at the time. He had a little bit of extra time as he was sort of coding and developing that business, and so he said that he'd step in and help us with some of the things that we were doing. So he comes out on this trip with us and sees a demo of Adipar at the time, and we said to him afterward, we go, "What do you think?" And he says, I think I just wasted 2 out of the last 3 years of my life because I could have done everything in a third of the time or less. That efficiency actually is what really created the ability to have a business today like we do, 15 years ago. And that's one of many tech resources that we use, but a lot of those tech resources didn't exist 15 years ago. So the technology landscape has evolved so quickly that it's enabled not only boutique firms to have great software and tech infrastructure, but arguably better and certainly more innovative tech infrastructure than a lot of the big incumbent firms, because they just simply can't adapt to the pace of change as quickly as boutique firms can.
Yep. No, that's absolutely right. And I think what's important to also note is that, when we were building the firm from the ground up, we weren't just, solving for, managing $100 million or $200 million. We were thinking much bigger than that. And so, Adipar, it's an amazing software, but it was by far the most expensive software on the market at the time, and probably still is for that function. But we were willing to make that investment because we knew it was going to be a differentiator and something that would help us grow, a firm much bigger than what we were at the time. So, I think, I remember we were making big investments, at a time when, I had 3 young children and you had
a third on the way.
On the way. And, a lot of nights of like, are we doing this right? Like, what are we doing here? But stepping back and 10 years later, I think it was the right decision, the approach we took.
Absolutely. Yeah, no, I'm glad we made those investments at the time because, otherwise I think and we continue to do it today, by the way. So I think when we think about the business today, we always think, okay, what's it going to look like in 5 years, 10 years, 15 years? And do we have the infrastructure in place in order to do that? Because things are progressing so fast. I mean, this is the goal of this, episode isn't to talk about necessarily AI, but I've got to say, like, if we're touching on technology, like the pace of innovation is accelerating so rapidly. I mean, we looked at software solutions today because now we're thinking about things like how do we incorporate AI applications into our business. We looked at software solutions within the really just the last couple of weeks that didn't exist 6 months ago. Like the developers started building them 6 months ago, and now they have these like unbelievable software solutions in a fairly short period of time. And it's because AI has allowed for the development of software in a much shorter time frame than has ever been the case historically. And it's interesting, but it's also a little bit scary viewed through the lens of a business owner, because you have to be so on top of progress in that space and making sure that you're adopting best-in-class solutions and continuing to reevaluate them every month, every quarter, semi-annually, annually, because things change at a pace that's just completely unprecedented.
Yeah. No, I couldn't agree with you more. I mean, just, how many demos have we done with these companies where we're like, oh yeah, we talked to you guys like 6 months ago, and they're like, oh, well, we're on like version 4 of that. Right. It's like incredible functionality added since then. And then here's our roadmap with another like 10 to 15 impressive things that they're going to add in the next, 3 months. So it's the joys of being a business owner, but also the tribulations, because you really have to keep up with a lot.
Absolutely. So, as we think about what's ahead, not just for the business, but really our goals here with this show, I think there's so many questions that we get from clients, and just from high net worth families that we interact with. And I think a big purpose of this is really to try to, through episode after episode, address some of those thoughts, concerns, and questions. So certainly so many things are top of mind on the investment side and the economy side. And we're going to do our mid-year kind of outlook soon, so I won't belabor the point there. But, we're getting so many questions around just the impact of the current administration's policies. What does that mean for markets? What does it mean for portfolios? What does the rate environment look like? What's the outlook for inflation? But beyond that, we get so many questions around like, how much risk should I be taking? Or, here's how much money I think I spend, but I'm not even sure. Can you test and verify that for me? Because like it's coming from so many different places in so many different ways. Or, has my ownership structure been set up for tax optimization purposes or to just be run really tax efficiently, estate and tax questions. And then also, we like to be the first call for clients, you and I. So we get questions around like, should I charter a plane? Should I do a NetJets fractional ownership, or should I go out and buy one? And what's the operating cost of a Challenger 350, right? Like, so we want to address those questions too. We'll have experts in, the aviation space on here, cybersecurity, the instances of identity theft and hacking. It's such a rampant issue, and a lot of the clients that we deal with, just being either high profile or just are wealthy, they can be targets of those types of things. So how do you protect yourself online, and what solutions are available, and what should wealthy families be thinking about? Art collecting, art appraisals. Like we're going to really try to tackle each of these topics on this show. And I'm really excited about it because I think, certainly everyone listening and watching will learn a lot, but I think we're going to learn a lot also through this process.
No, I agree. I think we're going to learn a lot. It's sort of in the vein of continuous learning, which we believe in. It's one of our core values here at Element Pointe. And, I'm excited. I'm excited for what's to come.
Me too. And to be clear, we have no desire to be, very famous content creators. I mean, maybe I do a little bit, but no. But really this is about sharing a little bit about what we think, what we do, hopefully learning as a group with everybody who's tuning in, as well, and being able to impart some advice and some knowledge where we can. So
awesome. Looking forward to the journey.
Me too. Well, thank you, everyone.
Thank you.
And
stay tuned.
We'll see you on the next episode.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions.